Jay and I are both financial advisors working in the Portland, Maine market. Both have degrees in business administration and finance. Both are licensed securities professionals, so they're required Series 7s and 66 exams. Both are licensed insurance producers. Jay is starting his 37th year in this space, in this business, and myself going into my 6th year in the industry. So we appreciate the chance to be with you all today. Now, the topic of Social Security, very much an overwhelming concept, a lot of various components to it. I know that the million-dollar question, if you will, what you all have sent in, many of you in preparation of this session, is the question of when should I begin collecting my benefits? That is very much an individualized decision. We're going today to try and provide you some guidance, some of our recommendations, our thoughts on how to go about determining the answer to that. But I just politely would like to say that this session is not really the time or the place for those of you to ask us, when should I start my own benefit? It's far too much of an individualized discussion to have in this group session. But you will get some nice tips and tricks on how to figure that out. Okay. So let me dive in here. Wanted to begin just with some very basic information about when the Social Security system was created. So the Social Security bill was signed into law back on August 14th of 1935 by Franklin D. Roosevelt. The legislation was originally established to provide two types of provisions for old age security, right? To try and help provide financial security to those who are aged in our country. The first provision was to provide federal aid to the individual states to enable them to provide cash pensions to the needy aged population. And the second provision was to generate and create a system of old age benefits for retired workers. This is the part of the Social Security piece that we're really going to touch on predominantly throughout the session today. So just a slight continuation here. Provision 1 initially provided immediate assistance to the destitute aged individuals in the country once the legislation was enacted. The second provision really was designed to be a preventative measure, was designed to try and reduce the extent of future dependency amongst the aged population and to ensure those workers that they were going to have income once they were retired throughout the duration of their lifetime. Now, I think the important piece to note here is that many Americans, many retirees in this country, unfortunately they depend too heavily on their Social Security retirement benefit. And they forget oftentimes that this program was created to be a help, but not to be an individual's sole retirement income or retirement asset. So a lot of the work that we do in our planning practice is continuing to stress the importance for folks to be saving in other places, taking advantage of employer-sponsored retirement accounts, taking advantage of individual retirement accounts. It's very important to have that to pair with the Social Security retirement benefit. Now, a lot of questions are posed with respect to how is the Social Security system financed, but also what is the future solvency of the program. We're going to touch on that at the tail end of this, but wanted to begin by explaining how the Social Security system is financed. So the system is financed through a dedicated payroll tax that many of us are all familiar with. When somebody works for an employer, the employer and the individual as the employee each pay 6.2% of the individual's wages into the Social Security tax up to a taxable amount, so up to a limit on your income. In 2025, the maximum taxable amount for Social Security is going to be $176,100. So you're only paying as an individual the 6.2% Social Security tax up to that cap on your income. Now, those of us that are self-employed, they are paying the full 12.4% tax on their wages. So they're paying both sides, if you will, of that 6.2%, the employer and the employee as a self-employed individual. Now, in 2023, the total income, including interest, to the two Social Security trusts, the disability income and the old age, totaled $1.35 trillion that were generated into the system in calendar year 2023. That breakdown of that $1.233 trillion comes from the net payroll taxes that we are all paying into the system. $51 billion comes from the taxation of the benefits that you're receiving, which we're going to speak on how your benefits are taxable. And then $67 billion is generated in interest based on how they have the monies in these trusts invested. So the system is funded primarily and overwhelmingly through taxation, through our payroll taxes. The next two slides here speak to how an individual can earn Social Security credits. So we learned how it's financed, we learned that we're paying into this benefit, but how do we actually qualify for the program and earn credits to work towards it? So an individual earns Social Security credits by working at a job covered by Social Security. For an individual to have been earning credits for years prior to 1978, they have to have or have qualified through one of the following. They either earned at least $50 in wages for employment covered under the law in any calendar quarter. They either earned at least $100 in annual wages paid for agricultural labor for years after 1954 and before 1978, or they earned $50 in wages paid for agricultural labor in any calendar quarter from 1951 to 1954, They either earned at least $400 in annual net earnings from self-employment in the taxable years 1951 to 1977, or they earned the maximum taxable wages for that particular year. So in that time period before 1978, these would be the four different possibilities for which an individual applies and is earning credits towards qualifying for the Social Security benefit. Now, it got a little bit simpler, certainly in the years after 1977. So to earn credits from 1977 through to the modern time, the commissioner of the Social Security Administration determines the amount of earnings that will equal a credit for each year. So for an example, in 2025, the amount of wages or self-employment income necessary to obtain a quarter of coverage is $1,810. You can earn a maximum of up to 4 credits each year, and the total earnings amount, that 1,810, can consist of non-agricultural wages, military wages, railroad compensation, agricultural wages, and or self-employment income. So they have certainly simplified the qualification of earning credits for those of us earning after 1977. Now, what are the different types of Social Security benefits? There are 4 different types of benefits that an individual may qualify for. The first, and really the focus of today's discussion, is the retirement income, right? Monthly payments based on your lifetime earnings that you receive throughout the duration of your life once you begin collecting. There are disability Social Security benefits, monthly payments for individuals who have a disability or blindness and enough work history. There are survivor Social Security benefits, so monthly payments to certain family members of someone who worked and paid Social Security taxes before they died. So it could go to spouses, it could go to ex-spouses, children, dependent parents, a number of different folks that can qualify for survivor benefits. The fourth type of Social Security benefit is the supplemental security income, known commonly as SSI. These are monthly payments to people who have little or no income and little or no resources and a disability, blindness, or have reached age 65 or older. So there's obviously, as we talk about these four different types of Social Security benefits, there's a lot of various scenarios in which someone may become eligible for a benefit. We're focusing primarily on the retirement income component as part of today's discussion. So in order to become eligible for Social Security retirement income, you must be at least 62 years old, and you must have earned a minimum of 40 Social Security credits. So back to a few slides previously, you must have met those qualifications and earned at least 40 credits, the equivalent of 10 years' time. One of the big questions that we get a lot in the planning that we help our folks and customers through is this question of full retirement age. And the full retirement age has changed of recent. It's been expanded continuously as life expectancies have continued to lengthen. Another piece that's important to note as we help folks with their Medicare advisement as well, the qualification age for Medicare and an individual's full retirement age for Social Security are not one and the same. So Medicare eligibility is 65 years old, and full retirement age for collecting your Social Security retirement benefit is going to be later than that. So you can see here, those that were born between 1943 and 54, their full retirement age is obtained at age 66. For those born between 1955 and 1959, there's a few different phases where you'll reach full retirement age. It's going to be 66 and then some series of months to get you to that point. So 66 in 2 months, 4 months, 6, 8, or 10 months in the year in which you are reaching 66. Anybody that's born in 1960 or after, their full retirement age is not now until age 67 is when they reach that point. Now, we're going to get to a piece in this that talks to you about the impact of taking Social Security in advance of your full retirement age or delaying it beyond your full retirement age. It is age 67. Now, receiving Social Security benefits while working. This is a very common question as folks are continuing to work, in many cases beyond age 62. Should I take my benefit and continue to work? What might be the impact? So an individual can receive a Social Security retirement benefit or survivor's benefit and work at the same time. However, there's a limit to how much you can earn and still receive the full Social Security benefit that you're eligible for. So if you are under your full retirement age, the Social Security Administration will deduct $1 from your benefit amount for every $2 you earn above an annual limit. That annual limit is set at $23,400 for calendar year 2025. So again, the Social Security office deducts $1 from your benefit amount for every 2 that you earn above $23,400. So it's very limiting for folks with respect to being able to have earned income prior to reaching full retirement age. In the year that you are going to reach your full retirement age, the Social Security Administration will deduct $1 from your benefit amount for every $3 you earn above a higher annual limit. The annual limit in 2025 is $62,160. Keep in mind that that $62,160 is only for the months leading up to your full retirement age. So if somebody reached that full retirement age in October of 2025, they could earn $62,160 in the first 9 months of the year and be perfectly fine. Once you've reached your full retirement age, so starting with the month that you've hit full retirement, there is no limit at all on what you can earn and still be collecting your full retirement benefit. So when you get to the full retirement age, there is no longer a limit on what you can earn. Are Social Security benefits taxable? Depends on the individual situation. So yes, they may be subject to tax, and it depends on the income that you're receiving in addition to Social Security. So wages, earnings from self-employment, interest, dividends. The individual will pay tax on their Social Security benefits if they file as an individual on their federal tax return and they have combined income, which I'll explain what combined income is. But if they have a combined income between $25,000 and $34,000, they may pay income tax on up to half of their Social Security benefit. If the individual's combined income is more than $34,000, then they may pay income tax on up to 85% of their Social Security benefit. And keep in mind, these are the figures just for those filing individual tax returns. For those that are filing a joint federal tax return, if your combined income is between $32,000 and $44,000, then you will fall into the category where up to 50% of your Social Security benefit may be taxable. If you have more than $44,000 in combined income, then you're in a situation where you may pay income tax on up to 85% of your Social Security benefit. So I know that that's a confusing calculation because you're not yet familiar with what combined income is. Combined income, when determining this calculation, looks at your adjusted gross income. It adds to that any non-taxable interest that you've earned, and it adds to it half of your annual Social Security benefit. So simply put, it's half of your Social Security benefit plus your other adjusted gross income sources plus the non-taxable interest. That is how they're determining the combined income. And that's how they're determining which of the categories you're going to fall into from that last piece. Now, folks sometimes confuse when we say up to 50% of your Social Security benefits may be subject to tax. It does not mean that they're taxing you at a 50% tax rate. It means that if you earn $1,000 in Social Security benefits, that half of that, $500, would be added to your taxable income amount. And the same with 85%. 850 of that 1,000 would be added to your taxable income amount. So keep that in mind when you're determining what you might be paying in taxes. Impact on the benefit amount relative to your full retirement age. So I prefaced this before. The amount of your Social Security benefit will vary depending on the age you begin collecting relative to your full retirement age. If you begin collecting at your full retirement age, you receive the full benefit that you're eligible for. There's no reductions, there's no increases. If you begin collecting a benefit prior to full retirement age, but not before age 62, right? That's when you become eligible. The benefit is reduced by 0.05% for each month before your full retirement age, up to 36 months. If the number of months exceeds 36, then the benefit is further reduced by 0.05% per month. So an example I think is easiest to illustrate this, right? If somebody begins collecting at age 62, so they start at the earliest age that they can, and their full retirement age is 67, not 70. Apologies again for this typo. We'll get these corrected. But you begin collecting at 62 when full retirement age is 67. The number of reduction months is 60, right? You're starting 5 years in advance of your full retirement age. In that situation, your benefit's going to be reduced by 30%. So you're going to collect 70% of what you would have had you waited until full retirement age. So this is a calculation that the Social Security Administration will help you to do. Certainly some financial professionals can help you to do this as well. But the easiest is to look to the statements provided by Social Security to determine the variance in your benefit amount should you decide to collect in advance of your full retirement age. Now, if you decided to delay collecting your Social Security benefit and you delayed collecting beyond full retirement age, you're going to receive an annual credit or an increase to your benefit through age 69. So an example here, someone's born in 1960, their full retirement age is 67, they delay benefits to begin until age 70, they're going to receive an 8% annual credit for those 3 years that they delayed the benefit. So their 67, 68, and 69 birthday years, they're going to receive an 8% increase to their benefit amount for each of those years. And so when they begin collecting at age 70, now they're receiving an elevated higher amount than what they would have been eligible for otherwise. How does an individual determine their benefit amount? Just mentioned this briefly a moment ago, but the Social Security Administration has now adopted and encourages individuals to create an account at ssa.gov. So the Social Security Administration's website is really going to be the best place for folks to verify and determine what they are eligible for. Through the site, you can go in and see your full earnings history that's been posted. You can see your estimated benefit amounts, and you're able to identify them at various ages. So you're able to see the impact of either beginning to collect early or the impact of deferring beyond full retirement age. For workers who are still actively working, age 60 and older, that do not have a Social Security account, the Social Security Administration actually mails them annual statements 3 months prior to their birthday. So they're providing that to you physically in the mail so you can be well informed as you do get closer to retirement. Now, claiming strategies. And I mentioned this at the onset, but this is the million-dollar question. We know that it is. We understand that. It's the question of, when do I begin collecting my Social Security benefit? Our advice to everyone is, when they can, work with a financial professional, right? Consult a professional in the field to help you determine the best timing. Whether that's a financial advisor, whether it's a CPA, utilize resources to help you determine this, right? Because it's very much a situational decision. Our office is not one where we tell every client that they're best served to enroll in Social Security and collect benefits at the same time. We think there's far more to it than to make it that simple, right? Questions of, do you file on your own benefit based on your own earnings history? Maybe you're better served to file based on the earnings history of a spouse. And then the question of, do I begin prior to full retirement age? Do I delay it beyond? It's very much situational. So what we encourage folks to do, customers of our office, utilize generally the following type of strategy. We encourage every one of our customers to schedule a consultation with their local Social Security office. I know that's not a fun endeavor. Some of you that maybe have done Medicare, they're not always the easiest to deal with in signing up for Medicare. The feedback, though, about interacting with them for Social Security benefits is generally quite positive. This is what they are paid to do and do every day and do quite well. So it's simply a consultation. It's a time to speak with a Social Security representative, to have them walk you through the different ways that you might be eligible to file, right? Are you only eligible to file based on your own earnings? Or might you be able to do so on a spouse? Or maybe you're eligible as a survivor benefit. They walk you through those various options and provide you that information. From there, our customers sit with us and have a review of these various components. And so we review the information that's been shared to you by the Social Security Administration. What we help folks to do, and this is really the driver behind the decision for our customers, is the building of a retirement plan, right? It's to conduct a needs assessment. Questions like, what is your health history? Is very important as you're trying to determine when to begin filing for Social Security. If somebody has a cancer diagnosis or a health condition that may limit their life expectancy, then that might push this decision heavily in one direction or another. Questions about an individual's other assets, right? Maybe they qualify for pensions from a former employer. What is the scope of 401k or 403b savings that they might have? All of those come into the equation in trying to determine the best time to begin collecting. So utilizing financial professionals to help build out a retirement plan will answer a lot of these questions. And for our folks, it's really the final decision maker. And so we then help them to file benefits based on the result of that retirement plan. How can you go about actually signing up and filing for benefits? You can complete the application entirely online through the Social Security Administration's website. So you use that same online account that you created to log in and view your benefits, and you can log in and complete the application. Our customers get recommended to actually schedule a second appointment with the Social Security office and have that representative help them to physically enroll. We just feel that this helps to eliminate possible errors of doing something online and allows the representative who's trained in doing that application to walk you through it. But those are the two ways that you can file to begin collecting benefits. A lot of individuals say, well, when am I going to get my benefits after I have filed? Depends on when you were born. So if you were born on the first day through the 10th day of a month, your Social Security benefit's going to be paid on the second Wednesday of each month. If you were born the 11th through the 20th, your Social Security benefit's paid on the third Wednesday of each month. And anybody who was born after the 20th of the month, their benefit is paid on the fourth Wednesday. So it depends when you were born throughout the month as to when you will be paid. A couple of last items for you, more in the realm of current events and current viability of the system. We just recently had a very big piece of legislation passed impacting the Social Security system. President Biden signed the Social Security Fairness Act on January 5th, 2025. We're still learning a lot about this piece of legislation. It has been published for a very short period of time. But the essence of this piece of legislation is that the act is eliminating the reduction of Social Security benefits for those who are also entitled to public pensions, right, from work not covered by Social Security. So there's two primary provisions that are being eliminated as part of this new law. The windfall elimination provision and the government pension offset are both being eliminated entirely due to this Social Security Fairness Act. So the windfall elimination provision frequently reduced Social Security benefits for those receiving Social Security and other pensions. In our practice, we experience this most frequently with retired educators, right? Those who might be receiving a pension as a result of their time teaching, they would have their Social Security benefits reduced as a result of having that other benefit. The government pension offset applied to those receiving Social Security and federal, state, or local pensions. That offset has now been eliminated as well. The early indications are that the legislation is going to restore full benefits to these individuals retroactively as far back as January 2024. So a lot more to come from this new piece of legislation over the coming months and years. We're still wrapping our hands around it, but it has been signed and has been enacted in the beginning part of January. The last thing I want to touch on before we open this up to questions here, I'm a little beyond my time, but it's just a mention of the long-term viability of the Social Security system. I think this may be the biggest concern that many of us have. So just a few pieces of information for us all to be thinking about with respect to this. In calendar year 2024, there were about 68 million Americans receiving Social Security benefits each month. This totaled $1.5 trillion in benefits that were paid out over the course of 2024. One of the biggest challenges of many, right? Longevity has become a challenge for the Social Security system. Individuals are living far longer than they ever were when the system was first created. But one of the biggest challenges is our shrinking workforce. It's the fact that we have less individuals paying into the system than we've had in previous years, and we have more folks drawing from the system than we ever had previously. So specifically, for the past 3.5 decades, there have been roughly 3.3 workers paying into the Social Security system for each beneficiary collecting benefits. So about 33 beneficiaries per 100 workers. Estimates in looking ahead at the system is that in 2030, so by the end of this decade, there's going to be just 2 workers paying into the system for each beneficiary. So we're now going to jump to a place where we have 50 beneficiaries per 100 workers. That's a big concern as we look forward to this system. There's no doubt that a structural change of some capacity is going to be needed to be able to support the benefits for our retirees long term. Estimates from many different sources, they vary a bit, but the general consensus is that the 2 Social Security trusts likely are to be depleted around 2037. So we're 10 to 15 years away from reaching this point. Now, it doesn't mean that benefits stop entirely at that point in time, but what it does mean is that the trusts are no longer able to pay out 100% of the benefits that they normally would. So we get to a place where benefits have to begin to be reduced across the retirees. So not to end on a dire note here, but the system needs attention. It does need some level of reform in order for this to remain viable for retired Americans moving forward. So we'll continue to see what that may look like and how that may develop in the coming years. Quite frankly, I don't know that we have any clients that take their Social Security benefit and invest it in a high yield savings account. I don't know that we have any persons that are doing that in our book of business. The yield components have been leaving a lot to be desired over many years of recent, up until the Federal Reserve has raised rates starting in 2022. So for a long period there was not much of an opportunity for somebody to put monies in a secure place in a high yield savings and actually have a high yield. In many of those instances, the continued growth of their Social Security benefit was more than what they could garner in a high yield savings account. So we have not, in our personal book of business, everybody is different, but in our customer base, they haven't been utilizing that strategy. The Social Security Administration generally provides a cost of living increase commonly from year to year, dependent upon inflation and how, quite simply, the cost of our goods and services are changing over that same time period. So it's not a given. It's not always the same rate increase. It's dependent largely on what's going on economically and where we are in terms of inflation. The other thing I'll note in that is a lot of retirees make the comment of, well, the government has increased my Social Security benefit, but they also have increased my Medicare Part B premium at the same time. I'm in the same place, right, that I was before. There is a provision that the government cannot pass along an increase to your Medicare Part B premiums unless they also do give you a cost of living increase on your Social Security benefit. So the fact that those two things happen generally at the same time is because of that hold harmless provision. But that does happen. And of recent, with where inflation has been the last few years, we've seen cost of living adjustments be given routinely.
Somebody asked if they delay their Social Security benefit to receive the 8% increase, is that 8% included in your full retirement benefit in perpetuity? Yes, it is. So once you start drawing that, that is the number you'll receive. Couple of others. Can I ask a survivor benefit question? Widowed, if I remarry after age 65, would my spouse qualify for survivor benefits? Your spouse could qualify for survivor benefits on your record of earnings, but not on a deceased prior spouse's record. 71, started collecting Social Security last year and have them deduct 22% for taxes. Still work full time. Please clarify how that impacts my tax filing. Back to what Carter discussed earlier, they determine how much of your Social Security benefit is taxable based on that formula that Carter showed you during the presentation. However, whatever is deducted from your Social Security because you made a voluntary election to have them withhold taxes, that also gets reported to the federal and state government, that just like it would if it was coming out of your paycheck. So that information is shared with them. So to restate, we will be paying taxes on the money we originally put into Social Security. Then if we delay, we are then paying again on the 8% increase as well. Yes, that is correct. You're gonna pay taxes based on the amount of income that you have. We went through the formula. So if you're taking a higher amount, and that could potentially raise your income, it may or may not change the amount that's taxable depending on your other sources of income outside of Social Security. But that's all dependent on an individual situation. There's no clear-cut answer to that. It's based on what your income is.